Welcome to today's panel discussion entitled Managing Funds by Strategy, Decoupling from the Back Office. I'm Frank Smetana, Product Marketing Manager at Charles River Development, and I'll be moderating today's discussion. Joining me from our London office, Alan Cutler, Product Management Director for EMEA. Alan has spent 12 years at CRD and comes to us from SunGard Trading Systems. Also on the panel today is Steve Milanowicz. Steve is responsible for our portfolio management component in the Charles River Investment Management Solution, and he has also spent 12 years at Charles River building out those capabilities. Welcome.
Thanks, Frank.
Thank you.
Alan, set the stage for us. What are some of the key challenges fund managers are facing in the current environment?
We've seen a huge increase in regulation over the past few years. MiFID II was massive. It was a European regulation that went around the globe. You've got GDPR, which is landing imminently in the next couple of days, SEC form. These drive up costs because fundamentally asset managers have to comply but cannot pass these costs on to the end investors because they're also facing competition from passive investment styles, which are driving the fee base down. So you've got this combination of increased costs but having to drive down the fees at the same time. Additionally, what we're seeing therefore is a drive towards M&A because you can consolidate technology stacks and staff and things like that to keep your cost base lower while trying to increase the number of assets under management under that cost base. So there's a lot of pressure on the industry right now.
Steve, what are some additional challenges you're seeing?
So as Alan has touched on, it's a challenging place to be for an asset manager. They're trying to effectively keep their clients happy. It's a challenging investment environment. We've had an equity bull market since 2008. We've had a bond bull run for 20, 30 years. Many experts think that that might come to an end. So how do I create products that are going to keep my clients happy, fit an investment profile from a risk-return standpoint, and also fend off passive management? I need to do this in a way that allows me to manage risk, operational risk, of course investment risk, but ultimately in a way that where one bad year or a bad trade isn't going to ruin the firm. Beyond that, I need to do this in a way that allows me to cut costs. So minimize the amount that I need to take on from a cost standpoint in going into new markets and launching investment products, all with a way that allows me to stay pace from a technology standpoint.
Steve, what are some of the key strategic initiatives that leading fund managers are launching in response to these challenges?
So one of the things we see our clients doing is trying to figure out how far they can scale their infrastructure. So as we're moving into new investment markets, delivering new investment products, I want to do this in a way that allows my end users, my portfolio managers, my traders to do more with less, right? So it's make sure that I can trade when I need to trade, manage the risk on the assets that I'm trading, be able to look through and manage exposure wherever necessary. And then beyond that since I'm going into new marketplaces, I need to keep pace with innovation from that standpoint.
Alan, what about concerns around providing greater transparency into exposures and performance?
Well, effectively, with the clients now trying to package up these products, they're trying to basically, instead of the old balanced funds, you see much more diversification of the product types. And therefore, that's potentially increasing more risk for the clients. But clients, of course, want to know where that risk lies. So you have to have that ability to look into all the various slicing and dicing of the products, but bring the data back, produce it to the clients, clearly communicating that value proposition and how you're getting the returns to them. We're seeing this diversity of product offerings really to see a way of attracting more money in, creating new products, meeting the end investor's goals. Because the fund management previously was like buy into a balanced product. Now it's much more a case of what is your target? Are you looking to protect assets while gaining some level of return, or are you younger in your requirements and therefore are much more happy with higher risks? So they need to be able to manage this and provide that detail out to the clients to see where this is coming from.
Great. Steve, let's circle back to this notion of new products. What are some of these products, especially around factor-based offerings?
We see clients trying to deliver investment solutions. So in the past where it was as simple as putting out a mutual fund or a separate account in an area that we had expertise, now it's a way that allows me, I'm looking for products that allow me to sell around passive management. So repackage some of the current capabilities, maybe layer on a certain type of hedging or alpha strategy on top of things. So we see our clients maybe packaging up, as Alan had pointed out, an equity mandate, an emerging market mandate, an inflation mandate, and then maybe even providing a duration hedge on top of that. All of this in a way to fit a risk-return profile that the clients come up with. So no longer is it just simply here's the type of strategy we perform. It's actually we're trying to meet this goal at the end of this investment horizon.
Okay. So risk has become front and center in the buy-side investment process, especially with the 2008 crisis and events after that. So risk spans a broad spectrum. There's portfolio risk, which we think of as the key thing to manage, but there's also operational risk, there's regulatory risk, and reputational risk. Steve, update us on what's going on the portfolio risk management front.
So the portfolio risk management process is part and parcel with whatever your fund management firm will do, on a daily basis. So incorporating that as part of portfolio construction and building these products is key to ensuring that the risk return profile is going to meet the investor goal. So that may include managing real-time risk from an exposure standpoint. That might be looking at the risk decomposition from a factor standpoint. So really trying to figure out, when I blend these assets together, am I taking on or exposing myself to something that I might not ordinarily be aware of? One step beyond that is also trying to provide that from a consistent analytic and pricing standpoint. So looking at all of my assets, even if I don't manage them myself, in a way that's consistent and cohesive, allows me to have my best understanding of portfolio risk.
Alan, what about the softer aspects of risk? Regulatory, reputational, operational?
I'm not sure regulatory has ever returned to the softer aspect of risk, but it's fundamental about if you're taking in these positions and creating these products, especially when you use things like derivatives. Taking equity positions, and if you overinvest or whatever, you can unwind quickly. If you take a derivative position, A, they're much larger to begin with, so you're taking on far more risk at that time. So you have to have the controls, and to meet that regulatory obligation, you're given mandates to stay within. You have regulations you have to stay within that control the boundaries of the investment. So you can't, on a spreadsheet, type in a wrong calculation and generate 10 times the number you wish, and then push it out into market. You have to control that before going to the market. So no one wants these positions blowing up, because it will come out, it'll be in the press, they will see that they're not a safe manager to be with. So you have to have that control in these environments.
Steve, we touched on this earlier, streamlining, consolidating, and cutting costs in response to margin compression. What are firms doing in that regard?
So we see the innovative firms building a technology platform that scales and that allows them to do trade whatever they need to trade, package their assets in a way that makes sense, but also not grow costs. So we see this from kind of two ends of the spectrum, right? There's the best of breed solution where users or clients might try to stitch solutions together from a front office, middle office standpoint. That can be costly, that can be risky. That also can be inconsistent in terms of pricing and analytic models. We see black box solutions as well, where that's a one-size-fits-all sort of equation, but doesn't allow clients to add their own secret sauce or flavor to the investment process. So we feel the best technology platform allows a blending of those. I can fit in best-of-breed solutions if necessary, but most likely I can do as much as I need to do in the investment platform and maybe tactically add on best-of-breed or my own special sauce workflow enhancements or tweaks where I need to.
Alan, adding on to what Steve is saying about best-of-breed systems, what are some specific problems with these asset class-specific systems that require lots of integration?
The big integration is the biggest problem, because you're moving data between multiple systems and it's consistency. If you're reporting to the clients and the regulators one thing, but somebody's using a different system that's using different data sets somewhere else, how can you guarantee that consistency and that risk control? And also it's the cost associated, every time one of these systems is upgraded, you're going to have to re-interface it, potentially revisit all the mappings. It might be on different data structures. There may be architectural changes for the underlying technology stack. So there's huge inconsistencies and problems that creates having multiple siloed systems. So we're seeing much more move to an enterprise level platform that people can connect into. So an open platform that if they do have special sources Steve mentioned, you can bring that data in, you can bring those results sets into it, but you have a large operational footprint to control this. And that way you get that accurate view of exposures, you get the total control of compliance through all the workflows, because they'll fall through on a consistent foundation through the investment platform. You remove redundant data, because you'll have consistency across data, across all the asset classes. And also some of the manual workarounds. When somebody's dumping into an Excel spreadsheet, that usually involves saving things down, loading them up. And it's time consuming and pointless. If it's there in the system and it's usable and it's immediate, why do all that?
Thank you, Alan. One big problem we're seeing in the industry is firms still seem too tightly coupled to their back office accounting systems. Can you discuss some of the problems that creates, Alan?
Yeah. An accounting system really is for the end investor. So if I create a fund, I am the end investor. So the accounting service serves me. It provides my reports, it provides my performance, it provides my fee calculations, things like that. However, if my manager has defined an innovative product that can basically be sliced into multiple pieces, the investment-centric view is very different. I want to manage this in pockets. I might have an equity slice. I might have a fixed income slice. There may be derivatives. There could be an EM debt component. And I need to manage these multiple pockets of investments rather than just one giant fund. I've got cash in various pockets that needs to be managed and looked at. And I need to see how those perform. The overarching investment manager therefore needs to understand how each of these pockets is performing so they can see where it's underperforming, overperforming over time. But the accounting system, the accounting-centric view, really just sees one legal entity structure and provides that detail out to the end investor. So really we're seeing that separation of those pieces into an investment-centric view versus an accounting-centric view.
And so touching on some of that investment-centric standpoint, we see fund managers, here we are in 2018, talking to prospects, talking to clients, where we see wealth managers essentially fighting over cash balances because we have an equity and a fixed income fund manager that want to build an effective product for their end client, but because of back office considerations cannot. We see fund managers wanting to create a portfolio or a fund where they want to actively track strategies by region, by investment style, and be hampered by that because they effectively can't do that from a back office standpoint. We see clients maybe want to farm out assets. So I might not have a certain area of expertise. I might want to create a product that takes some of my expertise, maybe on the fixed income side of things, packaged with an equity manager or maybe even a multi-asset manager, and then want to be able to view exposure across those, track performance, be able to run compliance to make sure I'm not overexposed to a certain area. And in some cases, I might want to add a certain level of alpha on top of that. So provided a hedging strategy, whether it's currency related, whether it's maybe a duration mandate, something from that perspective. In some cases, we see 2 or 3 of those under the same investment management umbrella. So in a perfect world, I have an investment platform that allows me to do all of that. And in a way that is investment-centric, that shows those products for a fund management standpoint that makes sense to a portfolio manager.
So, Alan, it sounds like strategy management is really the key ingredient here as we uncouple from the back office. What advantages does that provide?
It provides that main thing of being able to say, I have, maybe a passive equity strategy. So I can give that manager money to manage. He can manage it alongside every other portfolio that he does that with. So I get the specialization. I can pass money to a fixed income specialist and manage that side of it. So I can look at the strategies, I can see the deployment of the fund to try and meet the investor goals that we're trying to package up. So I can define my product utilizing the specialisms of various areas and maybe having overlays that sit on top of this. We see cash coming in. It needs to therefore be allocated. So I need to be able to take the money at the top level and apportion it out to the various pockets as needed to drive that forward. But also it's that use of derivatives. to say, well, because moving money in and out of markets is expensive and costly. So fundamentally, if there's a short-term move, you potentially want to do a currency overlay or a derivatives overlay that moves assets across between the strategies in an exposure standpoint without moving money in and out of the markets at the same time. So therefore giving much better rates of return to the clients in these new products they're creating.
Okay. So, Steve, how do firms deal with an accounting system or a back office outsourcer that doesn't support a fund's required level of granularity?
So we've seen the clients be able to do this effectively only with an investment book of records that effectively allows that disintermediation between the back office and, I'll call it a front office perspective, or the way the front office wants to look at things. So that allows effectively separating fund structures, being able to aggregate things on the front office, and decompose things however I like, and let the back office be the back office, as Alan said, service those mechanisms that's good at. Once I've done that, so once I have the fund management structures, the position data in the front office clear, I can then look through all of the assets and effectively manage exposure. So in many cases, these are pooled instruments, either listed securities or mutual fund separate accounts, either housed internally or externally. I need to manage the exposure to underlying assets and track risk, and I might not necessarily manage those directly. So in a way that allows me to look through any of those pooled assets and allow me to aggregate those, I need to be able to do that consistently and accurately. One step beyond that is doing that in a way that allows for consistent pricing and consistent analytic measuring. So when I'm tracking these portfolios, or maybe even the strategies against their respective benchmarks, I might want to use specialized analytics, but maybe rolling these up and doing a duration hedge. I need to make sure that I'm pricing these things, valuing them consistently, and then providing that alpha construct in a way that makes sense.
Alan, additional thoughts on that topic?
I think one of the big things about this, the investment book of records allows you for a complete decouple of the accounting platform, which gives you opportunities to outsource that. Because as we said, the accounting view is an investor-centric view, not the investment-centric view. So it's all about the accounting side of it, how the investor sees his detail. That's scalable, commoditized, and can therefore be outsourced to large-scale managers to do this. It's not adding value to the main investment manager himself. Whereas the middle office purely serves that front office view. The investment book of records provides accurate positions in real time to the front office. It can provide the corporate actions across all the strategies, which may be rolling based on end of market closes around the globe, so not tied to that accounting system having its batch cycles. You've got the consistency of pricing, the performance of each of the strategies to understand and work through all this. So that whole middle office piece serves that investment view of the world and that drive towards better alpha in that area, while the back office can just be purely, in some respects, outsourced or compartmentalized into another area.
Okay. So it sounds like there are opportunities, both good and bad, for outsourcing. One obvious one is the back office. Steve, what other thoughts do you have on outsourcing? What should and shouldn't be outsourced?
So as Alan mentioned, when we talk to our clients, they're investment management shops. They're good at managing money, trying to grow assets, control risk, service their clients. They shouldn't need to have to manage a back office process. And maybe in the past, going back to earlier points, they are looking to scale. They're looking to cut costs. With a tool like an investment book of record, that allows me disaggregation. I can outsource my back office and manage things from a front office perspective without adding cost. I can also manage my risk more effectively that way when I'm looking at my assets in a certain way. Beyond that, if I've got the right technology platform, I don't need to manage that. I can outsource that, move that out to the cloud, keep pace with innovations on that standpoint. So maybe it's new assets being traded, new markets being handled, new capabilities from a risk management standpoint. I shouldn't be incumbent on needing to consistently upgrade a platform, or as Alan said, stitch together best-of-breed solutions. By outsourcing both the back office as well as some of the technology platform, I can concentrate on managing money.
Thank you for those insights, gentlemen. We have time for a few follow-on questions. Steve, I'll give this one to you. Data management seems to be front and center. Very critical challenge for asset managers. There's right ways, wrong ways to do it. What are your thoughts, especially in regards to supporting product innovation?
Sure. So data is one of the more important pieces of this, and in some cases might be the weakest link. So having data as a service is important because effectively I should be able to outsource that, give that to a data provider or a data service that here are my requirements, give me the data, give me tools that help me manage that data. So if it's inaccurate, if there's missing data, I want to be able to have workflows and support that help me control the risk around that. But ultimately, let me do that like anything else, like a technology product. Allow me to have that as a service, not as a process. Once I've done that, then I can get back to managing money and having some control around how accurate that data is and offloading that onto someone else.
Thanks. Alan, from your perspective in EMEA, how pervasive are the challenges we discussed on a global basis, and what are some of the regional nuances?
I think the challenges are common across the globe. Managers are trying to create innovative structures to make money for their clients, trying to attract more money. That's a fairly common theme globally. It doesn't matter which market you're in at this point. You get different nuances, though, because of different accounting regulations. And in some respects, that lends itself to that back office outsourcing because it's a specialist area potentially for a country. But there's also the regulatory side of it. MiFID II was a very European-centric regulation, but it had knock-on effects globally as well because it is a global investment universe we work with today. So we're seeing that constantly going on. And we're seeing much more use of the derivative side of things now with these specialist products to gain more alpha, gain more market return for the client base. Because it's ways to get into markets quickly and effectively, get large exposures without moving direct capital around using the synthetic products. So we are seeing those very heavily in Europe, but I think that is a global perspective as well.
Thanks. Steve, one final question. What is your future-looking view of the whole front to back office for buy-side investment managers?
So we see the back office increasingly being replaced by called a universal book of record. So a mechanism or a tool that allows me to manage position data accurately, manage exceptions, do reconciliation in a way that scales, and in a way that makes sense, that effectively guarantees accurate data for the front office. Once that's done, then the front and middle office lines continue to blur. So things like collateral management become more part of maybe a portfolio manager's considerations. Not necessarily their job, but they might help manage that process in a way to A, reduce costs, but maybe juice returns, gain alpha from another standpoint. Automation is going to be key as well. So having a tool that allows me to do reconciliation without having personnel need to manage each and every one of those is going to be important, because effectively, going back to earlier points, I need to be able to cut costs, I need to be able to do my job without worrying about the accuracy of data and do it in a way that scales.
Thank you, Alan. Thank you, Steve, for sharing your insights today. And thank you for joining us today. We hope you found our discussion on managing funds by strategy, decoupling from the back office, informative. We're happy to take any follow-on questions. Please contact us at crd.com.